In our strategy, we use a five-phase cycle framework. We are not predicting headlines. We are tracking signals and sequencing risk as the cycle evolves. Markets look strong on the surface, but households feel under pressure. This gap matters more than most people realize. We are reviewing a Bravo's research video. It focuses on corporate profits versus personal income. You should watch the original for full data and charts. The video shows corporate profits growing much faster than wages. That relationship flipped about 20 years ago, and the gap is now near historic extremes. This matters because profits and wages split the same economic pie. When profits rise faster, asset prices benefit first. Households do not. This is happening because corporations keep a larger share of output, and when that happens, money stays inside financial markets. It does not flow evenly into paychecks. Markets price earnings, not living costs. As long as profits rise, markets stay calm. That is why this divergence can last for years. Personal income as a share of GDP has been falling for decades. Consumer sentiment tends to fall with it. That tells us stress is building underneath growth. Corporate profits rise when income share falls. These lines move in opposite directions. That tension is structural, not temporary. In our strategy, this fits a late phase 1 environment. Assets are strong, but fragility is quietly increasing. High after-tax profits support high valuations, but they also make markets sensitive to margin pressure. Small changes can have large effects later. Pre-tax profits are not extreme historically. After-tax profits are. That difference comes from policy choices. If after-tax profits fall, asset prices feel it first. Layoffs usually come later. That is how wealth transfers occur in downturns. High multiple equities, profit-dependent sectors, and indexes driven by concentration. This is why high beta growth can be fragile. This is why concentration risk matters late cycle. This is why liquidity matters more than narratives. Quick note here. This is educational macro analysis only. It is not financial advice. This does not tell us when a reversal happens. It tells us where risk builds first. Timing depends on policy and credit conditions. We tighten exit discipline. We avoid leverage. We preserve flexibility. We do not short markets on ideology. We do not assume immediate collapse. We stay process-driven. Near term, this environment can persist. Over time, phase 2 risk rises if margins compress. That is sequencing, not prediction. Income share trends, profit margins, credit conditions, and liquidity signals. We do not need to be early, we just cannot afford to be late.